Welcome back to Switzer on Australia's Business Channel. Now, for another view on this post-election bounce, Julia Lee from Bell Direct will also analyse the stocks worth playing following the earnings season. Welcome, Julia.
Thanks, Pete.
Great to see you.
Good to see you too.
All right, let's start with election first. Is this what we're seeing now, election bounce?
We are seeing a little bit of an election bounce, but I think if you view the market and different sectors, interest rates, earnings as moving in different cycles, hopefully this is the beginning of an uptick in some major cycles. And they're things like business confidence, consumer confidence, which are of course great news for some of the cyclical areas of the Australian share market as well.
Yeah.
And if we have a look at it in terms of earnings, we're also at a turning point. So the last financial year we saw virtually flat earnings growth, but this financial year consensus is still for 13% earnings growth. So, you know, the last 3 years we've seen negative or flat earnings growth. It's now starting to turn and we're at an inflection point, and that bodes well for shares in the medium to long term.
So last financial year, flat. And what did we do? Did we do flat? A little bit less?
Well, in terms of share price performance, it was actually...
No, not the share price, but in terms of earnings, did we come in pretty well flat?
We came in pretty well flat, about -1%.
And for the next financial year, did you say 13?
13%.
Okay, so that should be good for share prices.
That should be good for share prices.
Have we run ahead in expectation of it?
Absolutely. The market always looks forward, so it has priced in that earnings growth. However, because things move in cycles, this isn't just a one-year story that we're looking at, but a multi-year trend. So while in the short term, it is quite normal to have pullbacks of maybe 5 to 10%, but I think the medium to long-term trend has changed to quite a positive backdrop for Australian equities.
So for someone like me, who's sometimes brutally accused of being too bullish, in saying that 2014 is probably going to be better for the economy and maybe good for stocks as well, is not too outlandish.
No, absolutely not. And if we have a look at this point in the earnings cycle, I guess the thing to remember is because stocks tend to run up before things happen, this is where the quality end of the market starts to look expensive. They're the blue chips, they're the big four banks, things like Telstra. And it's probably time to switch to some of the more mid-cap and smaller stocks. That's where the value is going to be, and look for earnings growth and earnings momentum, and that's the type of strategy which tends to outperform at this point in the cycle.
And when it's funny when you use the word switch, because switch is okay for traders, people living on the edge like a young person like you. But for a lot of my viewers who maybe bought CBA at 45, you're not going to switch out of that. You're going to laugh your head off. You're getting the dividends, you've got the capital gain there.
And the dividends and the capital gains are a consideration. But the fact is, a buy and hold strategy works fantastically well when you have a stock like Commonwealth Bank and it moves in one direction. It doesn't move so well when you have multi-year trends which are sideways or even going down. If you ask a Japanese investor that's invested in the Japanese market over the last 30 years, you know, they've seen around about an 80% deterioration in asset value from the peak to the trough. Obviously, a buy and hold strategy doesn't work so well there. But the biggest rallies have been massive, 2003 to 2007. Now, that's not a short time frame, it's a 4-year time frame. 125%, the Nikkei 225 increase. So I think it depends on the type of market and the type of stock that you're in. And if you're in a market that's just going up, well, buy and hold strategy works very well.
And particularly if you are in a retirement mode, if you select the stocks that pay good dividends, you just ride the capital up and down. As long as those dividends keep delivering you what you want.
Absolutely. So with the dividend strategy, I guess we are seeing a little bit of a shift in terms of portfolio. So a little bit less in terms of dividends, a little bit more in terms of growth. But in terms of dividends as well, you still want to see that earnings growth coming through because you want to see the dividends rising year after year.
Yeah, okay. So in terms of the earnings season, are you saying because you expect the 13% or even more increase in earnings, you have to start looking at different stocks? And if so, what stocks are on your radar screen?
Okay, the growth areas of the market are probably things like the energy sector. The healthcare sector has continued to perform well as well. Things like media are expected to outperform.
10? would you put your money into 10?
I think it is time to start putting some money into some of those unloved media
Fairfax
companies.
too?
Fairfax as well.
You are a thrill seeker. Yeah.
Well, the structural challenges is there, but what we are seeing is a change in the cyclical cycle, and that should bode well for these stocks. So business confidence returning should add to advertising spend, which has been a major issue for these type of companies. I think the other thing to watch is that we are seeing a weaker Australian dollar. So those companies with overseas revenue, stocks like ResMed, even Crown, Fox, 21st Century Fox, I think all these companies, they're going to get a bit of a kick up from that Aussie dollar. And earnings momentum from this earnings season, you still have those companies like Seek, REA, car sales with positive earnings momentum and positive price momentum. Breville's done quite well, Challenger Financial Group's another standout there. So just looking for those stocks with strong earnings momentum as well as strong price momentum.
But a lot of people are saying to me, Julia, we've run up so hard, there doesn't seem to be any value there. What do you say to them?
I absolutely agree that we've run up hard in certain areas, and certainly the blue chip end of the market, the large capitalisation part of the market has run hard. And that's quite normal for this part of the cycle because, we come out of a bit of a downturn, and the first thing that investors tend to do is buy their favourite stocks, the big blue chips that look undervalued. Once that starts to get expensive, there tends to be a shift into some of the more medium to smaller cap companies, but still looking for growth, but at reasonable prices. So you're probably still looking for valuations and PE ratios under 18, but still wanting to see that earnings growth.
Okay, let's talk retail as well. Retailers were beaten up, and they were beaten up so badly they came back. Now, let's take a company like Harvey Norman. I actually said, well, maybe in my Switzer Super Report on the weekend, so well, maybe it's time to look at a company like that. What are you guys thinking of a company like Harvey Norman?
Well, you only have to have a look at the auction clearance rates at the moment. And a stock like Harvey Norman, it's high leverage to things like white goods and household appliances. And when you see strong home sales coming through, that bodes well for Harvey Norman. Most brokers have already started to become quite positive on Harvey Norman.
Yeah,
and of course,
it's gone up the last 2 days.
The stock's run really hard. Over the last year, it's actually up 50%. And over the last
the shorts
3
were
months,
getting stuck into it at one stage, weren't they? And then when they had a slightly better result, bang, they came back. Yeah.
And the important one with that is that consumer confidence tends to move together with stocks like this. So consumers' confidence was up in August. We'll see another set of numbers out tomorrow, and hopefully that's the start of a trend in terms of...
Well, I'm interviewing Jerry next week. We'll see what the great man has in store for us. It'll be entertainment, plus I'm sure there's a little bit of insight as well. So that's that. Everyone's talking JB Hi-Fi, so I'm not going to ask you to do that. Do you think that the internet threat to retail is going to be there, but it's going to be limited, or it's going to get bigger and harder for retailers?
I think you'd have to say that you'd want the bricks and mortar retailers to really catch up quite quickly in the internet space. The internet's not going to go away, and internet shopping is not going to go away, and this is going to be a growing area. So they have started to try and catch up. Some retailers are doing better than others in this area, but I suspect we might even see some consolidation in this area where some of the big retailers may buy a platform that's already quite well established because they're running so behind it.
Yeah, I'll ask this question. You're always well dressed. Do you go to David Jones to see what they got online? Be honest.
I actually do most of my shopping online.
Yeah, but do you go to David Jones?
Online I do.
Do you?
I do. And the other...
Are they now delivering? Because a couple of years ago they weren't. Are they now offering stuff for someone like you? Because you're in the demographic that spends. You're fabulously well paid, a highly successful woman. You're on TV. I'm building you up as you should be. But I'm taking you as a classic demographic. Are they getting your eyes? And that's the name of the game.
No, still too hard, still too slow. Some of the international websites
and that sort of
are cheaper, easier to shop with. But the other interesting one is I often go to the Westfield website because you can browse a whole heap of their shops
like a shopping mall.
The Westfield portal, and delivery in the city. I think 3 hours. So if you want a new outfit for Friday, they'll deliver it to you that day.
Oh, really? And are you long Westfield shares as a consequence?
Well, Westfield's looking great because the US story is picking up, and
but also that's interesting, that insight you're given. A lot of people wouldn't have thought about that. I know they've invested in that shopping mall idea. That's a great idea. Isn't it?
And I think the development potential for Westfield is really where the upside comes from. But I remember when I was in the US for the first time, and I said to my friend, "Can you take me to a shopping mall? Because I've read all these books and they talk about these US shopping malls." And so she took me to one, and there's this big Westfield sign up.
Yeah.
And I thought, well,
I saw the same in Los Angeles. It was huge at Century 21, wherever it was. And it was Westfield.
yeah. So the US story and the US improving economy should be great news for Westfield.
Always great talking to you, Julia, and we hope you're right.
Thanks for having
Okay,
me.
bad news for doomsday merchants with good news coming from China, the NAB Business Survey. And on top of that, our stock market is closing in on its all-time highs. Let's take the last good news item first, with the All Ords Accumulation Index, which adds capital gain from higher stock prices to dividend payoffs to give you the overall return from stocks, now nearly at the best level ever. Of course, we have to get to 6,873 before we pass the old high on the All Ords, but the All Ords Accumulation Index underlines the importance of dividends in overall stocks returns. Helping to power stocks up today was another good read on Chinese economic data, with industrial production up 10.4%, which was the best figure in 17 months. Meanwhile, the election effect has come earlier than expected, with the NAB's latest business confidence survey coming in at plus 5.7 in August, which was at a 27-month high. And it comes as business conditions now, while better, were still negative 6.3. That can be summarised this way: that things stink right now in the economy, but the outlook is getting rosier, which is linked to the lower dollar, lower interest rates, a better China story, and the anticipation of the election result we saw last Saturday. This trifecta of good news once again makes doomsday merchants look way off the money, and augurs well for my expectation that both the economy and stocks should have a great year in 2014. After the break, we'll look at the hazards of being a boss in the modern workplace.
That was great, Peter. Thank you.